Bismillahirrahmanirrahim. Welcome to my business educational platform. Remember in last lecture we discussed the topics from the value creation and the overall cost of capital. That include the cost of debt, cost of preferred stock, cost of common stock. Then we move forward to the calculating weighted average cost of capital. In today's lecture, we will discuss the capital budgeting and estimating cash flows. So, the capital budgeting process, classification of investment project proposals, and the capital budgeting techniques that include the payback period, discounting payback period, net present value, internal rate of return, modified internal rate of return, and the profitability index. So, what is capital budgeting? Capital budgeting is the process of selecting, evaluating the project that maximize the wealth of the company. The process of identifying, analyzing, and selecting investment projects whose returns are expected to extend beyond 1 year. So the capital budgeting process starts from the investment proposals that are consistent with the firm's strategic objectives. Then we will move forward to the estimating after tax incremental operating cash flows for the investment projects. Then we will evaluate project incremental cash flows. Then based upon the criteria, we will select project based on value maximizing acceptance criteria. Then we will reevaluate implemented investment projects continually and perform post audits for completed projects. So we will keep reevaluating them. So how the classifications of investment project proposals is done? It starts from new product or expansion of existing product. So we will go for new product or expansion of existing product. We will formulate a project for that. Then we will see the replacement of existing equipment or buildings. Then we will also formulate a project based upon research and development. Either we are moving forward to the exploration or something else, then we will choose the brass project based upon that, or other safety related projects. So what are these type of these projects exist in our daily life? These are the some of the examples that are assigned to the projects. So after evaluating the projects, there exists the screening, proposals and decision making. There exists the section chiefs and the plant managers, vice presidents for operations, capital expenditures committee, presidents, board of directors, who make the decision whether we should go for this project or not. So now we are moving forward how the project evaluation is done. It is the very essential topic in the business finance course and alternative methods. So what are these approaches used to evaluate the project? There exists the payback period, there exists the discounted payback period, net present value, internal rate of return, modified internal rate of return, and the profitability index. So here is an example that we will continue in our today's lecture, that is of proposed project data, that is of Mariam's. She is evaluating a new project for her firm Basket Wonders. She has determined that the after-tax cash flows for the project will be 10,000, 12,000, 15,000, 10,000 and 7,000 respectively. For each of the years 1 to 5, the initial cash outlay will be 40,000. The initial cash outlay means the initial investment will be of the 40,000. So we will continue this example to the project's evaluation criteria that we will be discussing in our today's lecture, that is payback period, discounting payback period, net present value. We will evaluate that project based upon these criteria. So currently there exist the independent projects and the dependent projects. Independent projects are the projects that do not depend upon any other project. like a project whose acceptance or rejection does not prevent the acceptance of other projects under consideration. Then we have the dependent project that is dependent of other project, a project whose acceptance depends on the other acceptance of one or more other projects. Then we have the mutually exclusive. So mutually exclusive projects are the projects if you will select the one, you have to reject the one. Elsewise, there is the alternative or that there is the trade-off. You have to select the only one project and you have to forgo the other project. A project whose acceptance prevents the acceptance of one or more alternative projects. So now we are moving forward to the project's evaluation technique. The first one is of payback period. So remember the Mariam's Basketballs Wonders project. Initial outlay was 40,000. We were receiving 10,000 in first year, 12,000 in second year, 15,000 in third year, 10,000 in fourth year, and 7,000 in 5 year. So what is the payback period? Payback period is the time required for the cumulative expected cash flows from an investment project to equal the initial cash outflow. So payback period tells us when the initial outlay or the initial investment will be recovered. So the period in which the project initial investment will be back, it is the payback period. So let us see how this is used. So remember what we will do, we will find the cumulative cash flows, and this is the same project like 10,000 in first year, 12,000 in second year, 15,000 in third year, and 10,000 in fourth year, and in fifth year we are getting 7,000. So if you will find the sum of these years, you will come to an end of fourth year that you will recover the 14,000 investment. So payback period will be of 3.3 years. So how we came to this answer? So here is an example, like we will write the years. So on today we are investing 14,000. In first year we are getting 10,000. In second year we are getting 12,000. In third year 15,000, and so on. So what we have did, we have find it out cumulative cash flows. Cumulative cash flows are cash flows that are being added to the subsequent years, like 10,000 plus 20,000 will be 30,000, 12,000 plus 17,000, and so on. We will add them back in order to find the initial investment, in order to recover the initial investment. So it is recovered in the fourth year. Remember, in fourth year we have positive cash flow of 7,000. So how the payback will be calculated? It will be calculated using n plus cumulative cash flows divided by cash flows. N is the number of years plus cumulative cash flows is the cash flows. Then when the initial investment will be recovered, we will divide it with the next year's cash flows, that is of 10,000. So I hope you understood the idea behind the payback period. Now we are moving forward whether we will accept this project for the Basket Wonders or not. The manager of Basket Wonder has the set a payback period of 3.5 years project of this type. Should this project be accepted? Yes, it should be accepted, as we are getting the investment in our 3.3 years. As it is of 3.5 years, so we are getting the initial investment in 3.3 years. So we should accept this project and we should move forward with this project. Now we are moving forward to the payback period's strengths and weaknesses. What are the strengths of payback period and what are the weaknesses of the payback period? So easy to use and understand, can be used as a measure of liquidity, easier to forecast short-term and long-term cash flows. Weaknesses exist that does not account for time value of money, does not consider cash flows beyond the payback period. Cut-off pay period is subjective, so it is subject to interpretation. We are going for 5 years or 10 years or 9 years, so it will be the subjective. Now we are moving forward to another technique of project evaluation, that is of discounted payback period. So discounted payback period is the period of time required for the cumulative expected cash flows from an investment project to equal the initial cash outflow at a discount rate. So in payback period we were not discounting, here we will use the discounting. So there is a difference of discount rate. So we will find the cumulative cash flows based upon the discounted rate. So we will be given the discount rate or rate of return, in which we will discount it for finding out whether we should accept the project or not. The period in which the project initial investment will be big, we will go for this project, elsewise we will not go for that project. So how we can remember, for basket wonder there is a rate of return for 13%. So we will discount them 1.1 plus 1.1 0.13 for 1 and for 2 for second year, for 3 for third year, for 4 for fourth year, and so on. And we will find the cumulative cash flows, and we will use the same formula of payback period. Here we will use the discounted cash flows, as we are discounting them, and we are finding the cumulative cash flows. So n plus discounted cumulative cash flows divided by discounted cumulative cash flows of next year. So we will find out the discounted payback period. So as per the basket wonders example, the basket wonder management has set a minimum discounted payback period of 3.5 years for the project of this type. Should this project be accepted, if you will find out, we will find out it by 3.8 years. So here the criteria is 3.5 years. So we will not accept this project, as we are not recovering the initial investment in 3.5 years. So we are getting the investment in 3.8 years. If you will simplify this 11,359, you will come to an end that 3.8 years. So now we are moving forward to the another valuation criteria of the project, that is of NPV. NPV is founded out using cash outflows minus cash inflows. Inflows are the cash flows that we will be getting in the years, and outflows is the investment that we will be making. NPV is the present value of an investment project net cash flows minus the project's initial cash outflow. So how we can find out? So remember, cash flow is minus 14,000. We are making the 40,000 minus investment, and we are discounting it, and we are finding the minus cash flows. As NPV is less than 0, so we will not go for this project. The management of basket wonder has determined the required rate is 13% for this project type. Should this project is accepted? No, the project is not. NPV is negative. This means that the project is reducing shareholders' wealth, and hence the project should not be accepted. So what are the strengths and weaknesses of NPV? NPV cash flows assumed to be reinvested at the hurdle rate, accounts for time value of money, consider our cash flows. These are the strengths, and what are the weaknesses may not include the managerial options for embedded in the project. So we will see in our next lecture, in next chapters. So I hope you understood the idea behind the project's evaluation techniques, in which we will discuss the payback period, discounted payback period, and net present value. We will continue it in our next lecture with other techniques of the project evaluation. Till now, Allah Hafiz. Like, subscribe, and press the bell icon button so that you can never miss any update from my channel. Till